How do you put all this together?
Well, we've been talking with clients over the past couple of days that we think there's a lot of the bearish news has probably been priced into the market, and there's not a whole lot of juice left in this bearish grape. And really, we've been kind of equating it to this weekend's Kentucky Derby theme, talking about trying to pick a superfecta where you're kind of limiting your risk, looking for a big reward. And I think the wheat market has the potential to do that if you're looking for bottom. Again, managing your risk is very key, but we know that the funds are very heavily short. A lot of the bad news priced in. If we can start to stabilize above some of these technical levels, I wouldn't be surprised to see additional short covering from the funds take us out and above some of these levels. For Chicago, 450. Obviously, a very psychologically significant pocket that we're looking at. It also represents previous support in the breakdown point from mid-April. If we're able to get consecutive closes out above here, I wouldn't be surprised to see another 20-25 cents in this market.
What does the trade think of all of this rain still happening in parts of the area where they're going to plant spring wheat? Because the spring wheat tour, also conducted by the Wheat Quality Council, won't be here for another couple of months or so. So is there any concern yet about being able to get that crop on the ground?
There's a lot of concern throughout the Midwest with regards to weather and spring wheat. We're focusing primarily on the effects of corn, and we've been talking about the funds position for quite some time in the corn market, holding the big net short. But I think the funds are really looking at themselves saying, hey, we're 15% planted. We're exactly where we were at last year at this time. The only difference that I don't think they're really taking into account is the fact that we have a much wetter forecast here over the next week or so. So if these forecasts continue to remain wet and we actually get what is predicted, I wouldn't be surprised to see funds get a little bit more edgy on getting out of their short positions. And I think we've really already started to see this in the corn market. We're trading, heck, nearly 20 cents off of the recent lows, which is pretty good. 375 for that July contract is going to be a big line in the sand, represents a key retracement, 50-day moving average, as well as previously important price points back in April. If we're able to get out above here, I think there's another 10 cents of upside in a relatively short amount of time.
So how much of the corn market and the wheat market are tied together?
I certainly think they're working together, and that's when they work best. It's hard when one's kind of putting a drag on the other. So it's nice to see them trading in tandem, and I think that would be more encouraging for the funds to try to exit some of those short positions, because we do know that across the grain and oilseed complex, they do have a record net short position. So if we can get all the grains working together, that's when they work best.
So does that leave soybeans out on the back porch?
It kind of does. Same type of deal with wheat earlier. We're kind of in uncharted territory, and when we're looking at a chart, we're looking for kind of previous interactions between buyers and sellers. So it's hard to find that technical support when looking at new contract lows. But if we're able to stabilize out above 850 to wrap up the week, potentially there's enticingness to get funds out of their short positions. If corn and wheat can work higher, potentially that encourages some funds to buy some soybeans back as well. Obviously, kind of the ace in the hole is China and a potential trade deal. They were talking about potentially something being done by next week, but soybeans kind of reflecting that there's nothing there yet.